Are these two dividend stocks bond alternatives? Let's see. I remember this like it was yesterday. I was reading an article on CNN Money back in 2007. It was in July of 2007. It said, instead of buying Bank of America bonds or actually certificates, why don't you buy stock? The dividend is paying more. The yield was paying more than the bonds or the CDs were, and it was taxed as qualified dividends as opposed to ordinary income, and you got some upside. So that sounds like a great idea. It's a bank. What could possibly go wrong? Kaplink, kaplank, kaplunk. We just proceeded to get killed. Don't buy CDs. Buy this Hartford floating rate fund. It's a CD alternative. Look, it has a 15-year track record, never once lost money. What happened? Got killed. All right, so I get very cautious when I read these type of articles. But let's take a look at what Globe and Mail up in Canada is saying about these two stocks. So let's get rid of this right here. And they're saying, and we're going to look at them together. Freehold royalties. This security may represent a defensive way to play the energy rally. First of all, I hate the idea of playing it. You're investing, you're not playing, man. It offers investors a 5.3% dividend yield along with a forecast price return based on consensus analyst estimates of 16%. Management has announced dividend increases with the release of its quarterly earnings for the past 3 quarters. Yet the payout ratio remains low. All right, so let's take a look here. We'll look at Schwab. We got Freeport. Let me read that. There we go. So we got trading at $7.75 roughly, down a 1.5 today, 1.37%. Excuse me. It's got a excuse me, still fighting this freaking cough. Market cap 1.2 billion, so definitely on a small cap, which is interesting. Annual yield of 5.06%, 40 cents a share as a dividend on an annualized basis. It looks like PE ratio of 51. Yeah, that's a little bit scary. So PE ratio not cheap, that's for doggone sure. Can we go back to? Let's go to charts. I want to go historically. They just paid dividends at the price that was reduced by. I don't know where this is headquartered out. I don't know anything about the stock. So let's go back to 2014. We got what's this right here? I want to pause it real quick. If you would have bought this in 2000, what's this right here? 14. You're paying, was that about $20 a share? Yeah, about $20 a share. And so you got killed, and you're down to 777. So you lost 6-7% on the share price alone. Now you were receiving dividends in that time period, but that's not good. I don't like that at all. Does that far back as it goes? Let's see if it goes back to 13. Does it go that far? Let's see here. I love it. It does go back. There we go. Sweet. Well, only 2000. That's weird. All right, it got trounced, and right here. What happened right there? I mean, it's at 25, and it went all the way down to friggin' 597, 547. Now it's at 777. So, but with a high PE, pretty significant off its high, over the last 10 years. So this got trounced in the last 10. It might be a value play, but with a high PE, I don't know, man. That would be scary to me. Look at ratios. I want to see how much debt, current assets. Let's see here. We're going to look. Oh, man, top stuff is fantastic. All right, price of sales. Significantly higher price of sales relative to the energy index. Price of cash flow, significantly higher price of cash flow relative to the index. Return on equity, basically zero. Dividend yield is significantly higher too. I just want to see. That's all good. I want to see. I'm looking for cash. I'm looking for book value. So you're basically buying it a little bit above book, so book is 4 and the price is roughly 8. That means you're buying it for 2-to-1 book. That's not so bad. Look at that cash per share. They got penny per share. Oof. Most recent quarter. Cash flow per share most recent year, 50 cents per share of cash. I like only have a penny per share cash because that bothers me, especially the PE ratio is so high. Current ratio. So they got a lot of cash on side to pay off their current debt. Only 76. Is this in millions or billions? Only 76 million in debt. That looks pretty good. Total debt to capital right there. Ooh, long-term debt equity. Yeah. Return on equity. So they're not kicking it. They're not kicking it. That's for doggone sure. I don't know, man. I'd be worried about that one. I mean, they got current ratio means they have enough cash to pay off their current or accounts receivable to pay off their current accounts payables essentially 4-1, but they got 76 million in long-term debt. Long-term debt to capital 12, long-term to equity 13. I mean, that's I don't know. I'm not touching that, man. They're paying 17 trailing 12 months, 17 cents a share as a dividend. They only got $1 of cash, and they're making money, but not that much. That's why that's why the PE is so high. So yeah, I would avoid that. But look, you do what you got to do. It's just me. I'm conservative in that regard. The other one is interesting to me. This is Emera Inc. This guy said he considers this dividend-paying stock a bond substitute. His business is primarily in regulated electricity generation and electricity and gas transmission. It's not exciting, but it's about as stable as stocks you find. So EMAT, Emera. So go back to Schwab, EMA, Emera. Let's see what they what the heck, man? Emera. Oh, okay, EMERA. Right there. That's right. Let's see what we come up with here. Yeah, let's see. Yeah, okay. So here we go. Let's go back to the chart. We'll go 5 years. For 5 years, she was so nice. Lord, she was lovey-dovey. Tom paid the rent. At the door I went. I want one bourbon, one scotch, one beer. All right, so we got it's at 45 now for the last 5. Yeah, there we go. So is that 35 a couple years ago, 5 years ago? Now it's at 46. There you go. So let's go to chart, see what this guy's done. Can't see my baby till the night before. Gotta get a drink, man. I'm gonna get gas. Gonna get high, man. Listen to me. One drink ain't enough, Jack. You better make it 3. I'm gonna get drunk. Don't you have no fear. I want one bourbon. Look at that. 44 back in 2010 to or 22 to 46 now. It's gone extensively high. Let's go over to the odds. I want one bourbon, one scotch, one beer. For 20. Oh, yeah, there we go. Look at this guy. So you've got some capital appreciation on top of dividends. So let's start off in the odds at what's that, $15 a share or something like that? $10 a share. So you've quadrupled in half your money, and you got dividends on that. Nothing wrong with that, man. All right. So let's see. Utility, so it's not going to be. You never hit a grand slam home run, but imagine the PE ratio is quite low. I think. Yeah, it's still 31. That's not. Oh, right here, 20 is right now. They're current right now, but still projecting their earnings probably drop relative to price. So their forward PE is 31. But their current PE is 20. So that's not so bad. They get $2 a share. Was it price 44, 46? There you go. You got your yield of 4.5. All right. Now these are going to have heavy debt, I bet, just because they're utilities, taking equipment and whatnot. So let's take a gander. Let's gander. Lower PE relative to its peers, lower price cash flow relative to its peers, higher return on equity relative to its peers, and higher dividend yield relative to its peers. All right, you like to see that, man. I always like to see debt. Payout. Ooh, they're paying a lot of their positive cash flow out. That always bothers me. A lot of, what's the dividend coverage rate? The ratio of income available to common stockholders, excluding extraordinary items for most recent trailing 12 months. All right, so they're paying, they're paying 100% of their income is going to the shareholders via dividend. Like net income. I'm not sure if that's net or gross, but anyway, that payout ratio of 90%. That's high, but I wonder if their payout. It'd be interesting to see if that has always been like that. I don't know the answer to those. Book value is 29. So if you sold and liquidated everything, you get about 1.5 times book value. The price is about 1.5 times book, which is quite low, and that would make sense for utility. But now they don't have enough to cover the current debts, that's for sure. So current and quick ratio, they don't have enough liquidity to cover the current debts. They don't have enough accounts payables, accounts receivables, and cash to cover the current bills, if that makes sense. So they're generating cash flow, but because it's a utility, cash flow should not be that hard to fall, that's for sure. All right, so they get 142% long-term debt to equity, which again does shock me. I don't know, man. That might be something to look at. Am I buying it? No. Just sticking with Fashion, VTV, baby. VTV or bust, but there you go. That's the country of Canada. Corona. Excuse me. Anyway, there you go. I'll put the link in the show notes to the paper with the article I read from Global Nail. You can look at it yourself, but if something like that is of interest, yeah. I tell you what. I want to do one other thing here. Hold on a sec. The Hartford Fund, which is what I got burned on in the mid to late 2000s, because this was the alternative to CDs and bonds and cash, because it had never had a down year in the previous 10 to 15 year track record. And it was short term, highly problematic bonds, but they're so short that you wouldn't think they'd be able to flip them over before they went kaplink, kaplunk. And it didn't happen. We got killed in this fund. So anyway, right now it's $9.68 the price per share. The yield is only 2.26. Wow. Well, I guess that would make sense. Floating rate, short-term stuff. But relative to what it was back when I was buying it back in 2006 and 7, it was like 6, and your regular bonds were about 4 to 3 to 4. So that makes sense. Let's take a look at performance here. Man, doesn't get annual returns. Or I gotta go back to, yeah, I'm sure this gives us annual returns someplace. Let's see here. I need my glasses. All right, let me find the annual returns. One sec. Let's see. Now this is the A share. Before a fund, this guy just launched in 2000. Oh, well, that's not right. I'm looking at a different fund. It was because of A share. Hold on a second. Let me find the other one. The C share too. Why are they saying it started right here? Get rid of the fund and then open back up again? Yeah, I don't think I like that much at all. You can see right here, this puppy was basically introduced at 10 and all the way down. Yeah, this let's see, to 9. Then it fell all the way down right here to friggin' 775. So that's in 2011. So you haven't made any money in this fund. You're going back 10 years. I'm not just picking on this fund. I'm just picking on floating rate funds. Why are they? That doesn't make sense, man. That seems fishy to me. Why are they getting rid of the previous years? Let me find something else. Yeah, so here's a fund. So it was now 30% in 2008. I wasn't showing that on Schwab. It's weird to me. Anyway, percent, just like your bonds or just like your CDs and your cash. Now 30% in 2008, right? Niet. Yeah, so just be careful when you hear this is an alternative to that. You're like, well, there's a reason why that's like that. And the reason for stocks is because they're aggressive more than bonds. That's just a fact. There's a reason why cash is paying low. Anything that's alternative that's paying higher there's inherent issues there. That doesn't mean it's bad. It just means you got to understand the issues. Anyway, love to hear your thoughts. See ya.